Every investor in the world wants to catch the wave of the next big trade. There's no time machine to go back and buy Amazon in 2013 or Apple in 2009. But what we can do is talk to the world's best traders about their next big buy. Join me, Harry Melandri of MI2 Partners, as we do exactly that on The Next Big Trade.
At times of crisis, your cheapest stocks actually grow faster than your most expensive stocks, which is a totally crazy thing that never happens. And it's happening precisely because of this like crazy turmoil in people's expectations, where everyone's panicking. And actually, that's kind of the most exciting time for betting that GDP is going to recover, right? And so if you buy really cheap things, you do extraordinarily well in the middle of a crisis.
So welcome to The Next Big Trade, and thanks for joining us. This week, I'm speaking to Dan Rasmussen, the founder and I guess CIO or PM of Verdad Advisors. Prior to starting Verdad, which I'm probably mispronouncing, Dan worked at Bain Capital Private Equity and at Bridgewater Associates. Pretty damn blue chip places to be working. He's a trustee of donations for the U.S. Episcopal Church, I should say, which is also quite a blue chip place to be working, if you ask me. But and an author of a New York Times bestseller on America's largest slave revolt. Now, as it happens, I prefer to be talking about that, but we're here to talk about finance related matters and trades and stuff like that. So, Dan, you keep busy, don't you?
Thanks, Harry, for that introduction.
So, how's it going?
It's good. It's interesting times in markets. The topic for today is crisis investing, and I think we're nearing crisis in a lot of places around the world.
So, it's an intro. Normally I try and do small talk, and I'm about as good at small talk as Richard Nixon. It's just not something I'm naturally good at, which my wife will tell you. But this time around, I'm not even going to bother. I think we should go straight for this trade idea, the next big trade idea. So why don't you kind of expand a little bit on what your next big trade is?
Yeah. So, market timing gets a bad rap, Harry. And I think everyone is very bearish on the idea of making tactical trades. And I think that one of the most interesting tactical trades for people to think about and prepare for is what to do in a crisis. And the reason I like crises is because everybody knows when you're in one, right? You never know when you're in a bubble or when you're in a bull market, right? Where right before it ends or right at the beginning, right? It's hard. Everybody can have those debates, but you're in a crisis, you know it. Markets are crashing. It's on the front page of the newspaper. Everyone's liquidating. Your crazy aunt is calling you and asking whether she should sell all of her stocks, right? I mean, it's obvious to everybody. And so what I've done over the past few years is looked at the U.S., Europe, and emerging markets and tried to define quantitatively what is a crisis. How do you measure it? How do you know you're in it quantitatively? And then if you isolate those times and you say, okay, let's pretend I only invest at those times. I'm in cash the rest of the time, and then I invest at those times. What should I do? And I think everybody should have a plan for this and think about it, because financial conditions are so different during crises. And I think crises offer amazing return opportunities. And it's so much better to have a plan for them, because if you don't have a plan, you're likely to get punched in the face, panic, listen to the wrong people, and act irrationally, because that's what you get pushed into doing when everyone's panicking.
That's right. I'm a great believer in the philosophy of Mike Tyson as well. He's one of our unsung philosophers, the great unsung philosophers. So the very first, so I'm an old man. You can kind of tell by looking at the pictures, but although I like to think I've got good skin, but I have lived through quite a few crises. And I'm not 100% sure you're right about people knowing when they're in a crisis, or rather, people often think they're in a crisis in the run up to a crisis before they find out that actually the crisis is next week, and boy, you're not going to like it.
Yeah, I think that's well put.
So tell me, what is the definition of a crisis? If you're doing quantitative work, you have to specify. What's the specification?
So let's divide it into the U.S., Europe, and emerging markets. So in the U.S. and Europe, I think that the best indicator for understanding where we are in the economic cycle, and specifically whether we're in a crisis or not, is the high yield spread. The high yield spread measures the difference in borrowing costs between high yield bonds and treasuries. And it's historically been a wonderful indicator because not only is it pricing how, real financial market participants are pricing bankruptcy risk, which is pretty darn important, and how they're thinking about new loans that they're making. But it also has a direct impact. So when the price of debt goes up for risky borrowers, that marginal borrower doesn't take that marginal activity that would have stimulated economic activity. They don't buy a new they don't buy a competitor, they don't build a new factory, they don't hire a new worker that they would have done had the financing markets been open. And so that then bleeds through, and those workers then don't get jobs, or the factory that doesn't get built, doesn't, flow down to that construction company, and then that person doesn't go buy jeans at the American Eagle. And so you have what Ben Bernanke just won the Nobel Prize, and he wrote actually a big paper on the high yield spread and what he calls the financial accelerator, right? And so once the question was, how do small shocks turn into big crises? And what Ben Bernanke was saying is that small shocks turn into big crises because of financial markets, all right? Because the price of lending goes up. And then that liquidity crisis or that financing crisis creates the problems that really get us in trouble. And so what I look at is in the U.S., I look at when high yield spreads go above about 600 basis points. Now, that's about one standard deviation north of the mean. Now, could you say 620 or 650 or 610, right? Of course, there's an arbitrariness about picking a number, which I get, but you have to draw a line in the sand. And 600 is a pretty good level to pick. And that's going to cover, spreads went above 600 basically in every recession, and then one or two quasi-recessions. So the big oil price crash in 15 sent spreads above 600 in the U.S., right? So there's some times that weren't recessions, but really created recession-like opportunities in financial markets. In Europe, you can also use the high-yield spread. The high-yield spread in Europe trades about 200 basis points wider than the U.S., so spreads have to go up to about 800 for you to really be in a crisis in Europe. But it's the same metric, and it works the same way. And if you look at forward returns from that moment, right? So once spreads hit 600 in the US or once spreads hit 800 in the Europe, that's what I've spent a lot of time studying. We can then look at emerging markets as well. And emerging markets are fun because there's about twice as many crises in emerging markets as there are in developed markets on a per country basis.
You get a lot of value in emerging markets. It's true. Twice as much value in many respects.
Yeah, you get twice as much crash risk and a lot less recovery rate, a lower recovery rate, right? So the U.S. and Europe generally recover every time, but you go to the Philippines or something, right? There are a lot of markets that just never recovered from some crash that happened 20 years ago, Iran or something, right? I mean, you just go down the list, right? And so in emerging markets, we define a crisis as a 50% drawdown in that country's equity market. And if you stop and say, okay, well, are we in a crisis right now, right? Or where are we in a crisis? We're not in a crisis in Europe. We're not in a crisis in the US, right? It feels like we're heading there, but we're not there yet. And we're at a crisis in several emerging markets. So Russia, Turkey, Poland, China, Malaysia. We've already crossed that 50% drawdown threshold. So I think we're in a very, very interesting place. The 10-year minus 3-month yield curve just inverted. And I think, we're heading into, is it 3 months from now? Is it a year from now? I don't know, but we're headed into a crisis, I think. And I think spreads will cross that point sometime soon. And so I think it's a great time, Harry, for us to be having this conversation so people can start thinking about, okay, what am I going to do? Right? Because if you think you're in pain now, and spreads are at 500 or so, you're going to be in a lot of pain when spreads are at 600, right? If you think your investments in Europe aren't looking too hot, right, and spreads now are at 600 or so in Europe, you're going to feel a lot more unhappy when spreads are at 800. And that's the optimal time to buy some assets. So thinking about, getting ready for that so that you're not, you've got some dry powder and you're not too traumatized when you get there to act is an important thing to start thinking about.
Yeah, traumatized in this case means you haven't had a 50% drawdown and have a bunch of investors screaming at you saying, let me out. It's really hard to put money to work in those circumstances. So I've spent time in bond markets. I've traded govie bond market swaps and derivatives, but I've also spent time in emerging markets. And what can I say? I'm a jinx. I go off to Russia in '98, and who knew? But few months after I arrived, the whole place disintegrates. It's ridiculous. So I've seen these things up close and personal. And the '98 experience, I don't know if I think, like, the reason why what you say works for high yield debt is to my mind, because financial conditions tighten and high yield debt is a marginal participant in the ecosystem that are financial markets. These are things that have loan to value ratios when you repo them as collateral of 50 cents in the dollar or 60 cents in the dollar. And you can't shove it into the Fed and say, thanks, can I get value for this? And so weak hands have to cough this stuff up. And I mention all this because, as I said, like, I was thinking when I looked at I do my MDD, the minimum due diligence. Sadly, I seldom do much more than my MDD, but there you go. So I was looking through your website and the presentations and stuff, and some great material in there. And I'm probably going to use it in all sorts of places in future. But I was thinking about what I saw in '98, sat in a seat in Moscow when that place was blowing up. And kind of like two phases or three phases. Phase one, people were querying whether or not there was going to be a crisis, and bonds were, Russian bonds were trading badly and going down every day. And yet people were still saying, I'm not sure there's going to be a crisis. I remember, that we got to about 50 cents in the dollar when I suddenly realized life would be so much easier if I just assumed there was going to be a crisis, rather than let's just assume it's going to go bad. Let's see how that feels. And it worked really well. That worked. Right. So secondly, there came this point about not long after it crossed the 50 cents in the dollar line for Russian Eurobonds, where margin calls took place. And in this case, it was mostly the domestics that carried a lot of that Russian paper, and they didn't have access to dollar financing. Of course not, they're effing Russian banks. Why the hell would you lend $1 to a Russian bank, right? What are you, nuts? So these guys suddenly, they didn't have enough collateral to fund those repos they'd done with Goldman's and with Lehman's. And then I saw, we got to this point where there's a capitulation trade. And I saw one particular investment bank, which may no longer exist, whacking every bid under the sun. And now you could easily say what they were doing makes perfect sense, because what do you think the value of a secondhand Russian bond is going to be in a financial crisis when it's not necessarily great, but this was not careful selling, right? So you could cut it both ways. You could say that the liquidity of the market required them to sell very aggressively to knock the price down. And I could definitely see that argument. But the other side of this coin was when we got down to 5 cents in the dollar for the Eurobond, or actually 10 cents in the dollar Eurobonds, 5 cents or 3 cents in the dollar for Minfins, the investment bank that was selling out that collateral bought the paper for their own account. So a cynical person, of course I am not a cynical person, a cynical person might say that the lack of care in selling out that collateral beforehand reflected their own financial interests, and they destroyed that market so that they could profit from it. That would be a cynical interpretation. But what can I say? Does that ring true? Does that tally with your statistical observations?
Yeah, I think there are a few really important observations there. One, you captured in this your talk about the dollar, right, and the importance of the dollar to these Russian banks, right? And the dollar is like the high yield spread to emerging markets, right? When the dollar starts to spike upwards, these countries are in serious trouble, right? They've borrowed in dollars. Their companies have borrowed in dollars. And when the dollar starts rising relative to their revenues, right, they're getting squeezed in a really bad way, right? And then you think about your options, okay? So all of a sudden my currency is plummeting in value relative to the US dollar. And so I'm thinking, oh gosh, what do I do, right? Do I raise rates to protect my currency? Right. Well, if you start raising rates to protect your currency, you're going to screw over your domestic economy, right? I mean, you're hiking into a downturn, right? So that's pretty bad, right? Or you keep rates low and and basically your currency stays in free fall. And, maybe your domestic, right? This is sort of like Turkey's approach, right? You keep rates low despite a crashing currency, and then you just risk, you risk just a, catastrophic inflation or devaluation of your currency, right? So and then you can try intervening in the foreign currency markets, which just never works, right? So you're caught in a trap as a central bank at these moments, these, balance of payments type crises. And so, I think the way I sort of think about emerging markets is that a lot of times you want to be sort of short emerging markets, right? So if you're just sort of short emerging markets, right? If you're just short a basket of them, right? One or two of these countries are going to elect some socialist or, something disastrous. They're going to rewrite their constitution to eliminate private property rights, or right? Something bad is going to happen if you're short enough of the bad ones. And then and I short them through the currencies. Okay, so you short the currencies, right? Because that's when those balance of payments crises,
that's where it manifests.
Exactly.
Yeah, absolutely.
Right, that's where it manifests. Right, and then you don't have to worry about the equities, which can go, be bubbly. And then when liquidity is drawn up, right, you think about a 50% drawdown, and let's say Russia, right? So they're the Russia experts, right? They're the Russia funds that probably owned the assets at 90 cents in the dollar, right? And they've been telling their clients, right, Russia's really cheap, it's really attractive, you should move money in at 90 cents in the dollar, right? By the time it's at 50 cents in the dollar, right, the Russia experts are done, right? Their funds are closed, they're getting massive redemptions, and nobody believes them because they were long at 90, right? And then you've got sort of the, the general emerging market funds that had a 10% allocation to Russia, and they only did it when it fell to 80 cents in the dollar, but now it's at 50 cents, and their investors are saying, gosh, your record in Brazil is so good, but like, why did you put money in Russia? And they're like, you're right, we fired that PM, we're out of there, right? So the generalist funds are out. And then, you just basically have free fall and panic, right? There's no bid. Who's going to buy it, right? And that's the point of capitulation, where liquidity has fled, where the currency is decimated, where I think there are really interesting buying opportunities. And I think we're there, basically there in a few EM countries now. And things are going to get worse. And I think we're probably going to see 7, 8, maybe emerging markets being 50% drawdowns over the next few months as things continue to unfold. You just look at where the dollar is, right? It's just sort of inevitable that these countries are going to be whacked. And you start to think about the level of panic, how cheap those assets are going to be. If you look already, you see, market leading companies in some of these markets trading at 2 times EBITDA, right? That were trading at 6 times EBITDA, a year or two ago. And the currency is down 40% or something, right? So, I think that these are really interesting times, but you have to realize that you are getting paid to be a liquidity provider to a place that can't get dollars, right? And can't get anyone interested because everyone smart that was interested has been burned so hard that they're out.
Yeah, this is kind of like debtor in possession financing, but without all the protections of debtor and possessor financings. So you should get paid. And I was thinking, like, this isn't your first kind of process, if you will. I looked at the Forbes article on you, which, by the way, is a fantastic article, or at least reading between the lines. You must have had a time and a half recently. I mean, you have been surfing the economic and financial market crises, both on the collapses and the rallies. And then it occurred to me as I was kind of going through that Forbes article that all the smaller asset managers, you've got a startup asset management company. This has been unbelievable. I mean, if you survived, hats off to you and maximum kudos, because a lot of guys didn't make it. It's been really choppy for guys who started up new businesses. But you look to me like your first kind of investment idea process was basically a Bain Capital idea, where you wanted to replicate the supernormal returns that private equity gets. And it seemed like the bulk of it, this is me reading, my reading comprehension skills could be higher, right? But the gist of it was that small companies have supernatural returns. You lever that and you're suddenly getting the kind of returns you see in private equity.
Yeah. So the original idea that I had was basically by looking at private equity as an asset class, and private equity has been everybody's favorite asset class for like 15 years.
Longer, at least
maybe
22
longer.
minimum, probably longer.
Yeah. And a big part of that's the returns are phenomenal. The historic returns phenomenal. And if you say, well, what were the private equity firms doing to generate these types of returns? They were buying small companies, generally about 180 million in market cap, right? True micro caps. They were levering them up about 60% net debt to enterprise value. And the sort of twist or the insight that I would say I had was that if you looked from, call it 1980 to 2004 or 5, over that period, private equity was paying about a 40% discount relative to public markets. Okay. So basically, if you were able to transact with, these family owned businesses or these carve outs or whatever, in the early 90s, late 80s, whatever, right, you could go buy these things at a massive discount. And if you could either grow them or sell them to a publicly traded company, you earned this arbitrage between private and public markets, right? And by the way, you were levered. So you were selling, you were buying at a discount, selling at a premium, and you were, 2x levered. So, what a surprise. It was unbelievable. And by, call it 2005-6, this gap had closed. And now private markets are more expensive than public markets, which is sort of remarkable, right? You think you're starting any liquidity premium, right?
Scaring me. Okay.
And there's a lot of scary stuff going on in private markets as a result of this, right? The rise of private credit, which is sort of a last 10 years thing, is terrifying. The asset valuations are crazy. And the sector concentration now is insane. So private assets are really disproportionately invested in healthcare technology and every private equities firm's favorite thing, healthcare technology.
That's right. Two great flavors rolled into one. It's magnificent.
And so what I said, this is sort of the mid 2010s was, gee, what I'm actually interested in is replicating what private equity used to do, right? Going by these small, cheap, levered companies. And I'd say 2014-15 was probably the single worst time to come up with the idea of small cap value in any flavor, right? Levered small cap value, micro cap value, deep value, right? Any flavor of that was bad. And honestly, any flavor of healthcare technology was good. So in some sense, I was completely wrong. Okay. Private equity made the right bet in 2015. I made the wrong bet for the next 5 years, right? We'll see who's right over the, longer term. I still think there's a logic to buying companies that are small and cheap.
I think you're right, but this is not the time, I think, for that strategy.
Right. And so, but what I got into, right, is looking at okay, there are periods where buying small, cheap companies has just been terrible for the last few years, right? And then there are those periods when it's been awesome. And so I started studying, what makes the difference, right? Can we predict it? Can we know in advance when small, cheap companies are going to work and when they're going to get crushed? And I actually found it's pretty simple. All relates to the high yield spread, right? So basically, if you look at big crises in the U.S., it's the same trade as we're talking about in emerging markets, right? If you're thinking about a small company that's relatively cheap, think of a classic example, like an auto parts manufacturer that makes seats for car, the cushions for cars, or a steel company that's an input into some manufacturing process, right? This type of company, they're a few $100 million in market cap, pretty thinly traded. Who owns them? Some index funds, some random families and corporate officers, and maybe one of the few last remaining active managers in small cap U.S. value stocks. And when a crisis comes and spreads blow out, these things get decimated, right? Well, they get decimated for a few reasons. One is the liquidity thing that we talked about in emerging markets, right? Small cap investors, they get redemptions, it gets whiplashed, things sell off. And as liquidity gets withdrawn from markets, the less liquid you are, the more you suffer. And the other dynamic, which we didn't talk about in regards to emerging markets, but it'll apply there as well, right, is that these companies that are really cheap, the value stocks, they tend to be GDP linked cyclicals, right? So when the economy gets bad, their revenues and profits are terrible. And that's true of the big emerging market champions too, right? Like the big companies in Brazil are going to do horribly when Brazil's GDP goes down, which is the middle of a crisis, right? And so what you have is then investors take that and they sort of extrapolate that forward. They're like, well, revenue is down 20% this year. What if it's down 20% next year? Like, what if it's an L-shaped recovery, right? But it never gets back to where it was, right? And I think that my argument would be that, at these times you're buying at a crazy discount, right? Like small caps are going to sell off, in a high yield spread type crisis, 40, 50%, right? And the market might be down 20 or 30. And so you're buying these things, they were already cheap coming into the crisis. Now they're 40 or 50% cheaper. And I think the interesting thing, right, is that at that moment in crisis, the chances actually that GDP recovers from there is actually pretty high, especially in the developed markets. And if GDP recovers, well, who's the biggest beneficiary? These really GDP-linked cyclical companies, right? Where, their revenue went down 20% when GDP went down 3%, but now GDP's up 4% and their revenues are up 30%. And all of a sudden, this company that makes, cushions for cars is growing like 35% on top line and 50% on the bottom line for a year, and you bought in at 3 times EBITDA. Right. And I think that's the brilliance of sort of small cap value investing, but with an overlay of saying, gee, of course, these companies are going to be the worst hit coming into a crisis. Of course, when things blow up, these sort of crappy little businesses are going to be the worst affected. But gee, if you have the dry powder to buy them, in the same way as if you have the dry powder to go into these EM countries and they blow up, you can earn just super profits, right? I mean, it's just amazing. These things are like rocket ships. If the recovery happens, which is obviously the bet you're taking. And I think that's really been our insight. And so we said, look, why don't you plan for that? Just make that a discrete strategy that, gee, when things blow up, I'm going to take X, Y, and Z actions that I might not normally take otherwise. I'm going to go dump a lot of money into small cap value. I'm going to go dump money into emerging markets. I'm going to look at other crises worldwide and find things that blow up and buy them. And I'm going to ride it out until it feels normal again and then sell. And then I'll just wait for the next one. And I think it's a pretty good idea.
So I agree. I do think it's a good idea as well. But is this a pivot? Like your original idea for a process, an investment process, was a little different to this idea. I'm just a ball of cynical with a little bit of flesh, actually quite a lot of flesh attached to it. But it occurred to me that it looked a bit like a pivot, but it was a genius pivot. Because if you're in a world which is no longer friendly to small caps because, high yield spreads is just a proxy for financial conditions. And it's a good proxy, a better proxy than most. It has a lot of data to it, which helps. I can imagine, Goodhart's law, that maybe that proxy can vary in the quality of the signal, but it's a pretty good proxy. Like the Fed can screw around by setting up a facility to buy high yield bonds, but it's a pretty good proxy. But it does occur to me that if you shift your investment process to focus on crisis and you're in a crisis rich environment, you've got the right meta investment process. Is that what you're thinking? Is that what the logic here?
I hope so. I mean, look, I'm a believer in small cap value as a buy and hold investment. But you also have to step back and say, gee, that's not been the right asset class for the last few years, right? You've been much better off in large cap growth or owning the FANGs or buying crypto or whatever, right? And so you have to, I think, living through that and saying, gee, through no fault of my own, my asset class was just terrible for a few years, right? And that's what pushed me to say, okay, let's start thinking about timing, right? I mean, it's a natural thing, right? How can I define when this is likely to work or when it's likely to not work? And can I do so in a replicable way? And so, I think that what I would say is going to look different about the future than about the past. And I think I look at the 70s as an analog for what I think we are, or at least we need to study the 70s, right? Maybe we're not re-entering the 70s, but there's lessons to be learned.
There are definite parallels.
And I think one of the things that you noticed in the 70s, like people call it a lost decade for stocks, and it was. And people talk about stagflation, and you sort of have in your mind like a 0% return environment, right? But actually the 70s was nuts, okay? It was like, huge rally, huge crash, huge rally, huge crash, huge rally, on and on and on, right? And I think what I sort of derive from that is that this is a pretty good time, right? If indeed we're returning to those type of conditions where we have inflation, where we have the Fed trying to fight inflation by creating recessions, if we have this sort of cyclicality returning back to markets, it's not the great moderation or this like long stretch in 2010s where everything just went up for 10 years. If we're returning to that type of volatility, I think this type of crisis-based approach, I think, is a really useful way, hopefully a very useful thing for investors to think about, right? Because you might not want to buy and hold, right? You might want to sell the tops and buy the bottoms if you can.
Yeah, the great immoderation. Someone's got to coin it. But absolutely, one approach is just to carry more cash and buy the dips when the dips are big. But here we're trying to run an algorithm to do something. The problem with judgment is that everybody's got it, or everybody thinks they have it. It's tricky. Quantifying it is probably a good idea to get for any process. And then one of the things that occurred to me in reading through your 86-page presentation. 86, yeah. Well, you can still see the scars on me from. And the problem is, it wasn't like there wasn't content there. There was a lot of.
You paid attention to that footnote on page 52.
It's probably slipped me by, but there was a lot of content there. A lot of Bayesian conditionals where you're testing A versus B, and very useful stuff. So it just occurred to me that, from a macro point of view, in crisis periods with tightening financial conditions, there's really clear investment advantage in having guaranteed capital. You are going to get paid because you have capital, and you're going to be able to scalp the crisis and make an additional supernormal return by scalping the crisis. And the question is not whether you'll get paid, because you will get paid. Right? If you're the only guy who can buy in a crisis, you're going to get paid something. Question is, how are you optimizing the monetization of that guaranteed capital?
Yep. Right. And so the question is, what works in a crisis, right? Okay. So you're in it, right? You want to deploy money. And I think there are a few lessons, a few pretty clear lessons. One, actually, an interesting lesson is that simple quantitative rules, the factor investing, et cetera, that stuff works better in a crisis, a lot better in a crisis than it does in a bull market. So think of like a simple thing like bankruptcy prediction. Okay. So you've got your great bankruptcy risk model tuned. Okay. And you go in and run that, and it's 2018, 2019, and nothing goes bankrupt. Like, what was the value of your stupid model, right? Like, nothing went bankrupt. Yeah, you predicted which companies go bankrupt, and then none of them did right? And actually, a lot of the ones you thought were going to go bankrupt did well, right? So your model is a waste of time. Right. You fast forward to a real crisis. Right. And actually, COVID is an exception here. So I shouldn't be talking about bankruptcy risk in COVID, because nothing went bankrupt in COVID either. But in a real recession where you see bankruptcy, your bankruptcy model all of a sudden is really valuable. Right. And all the companies you think are going to go bankrupt do go bankrupt. And you are the one that thought to use that model. And so it's great. So it turns out that simple quantitative rules work really well in crisis. And in some ways, this is logical, right? Because the quantitative rules is taking advantage of people's emotional, basically bad judgment that's driven by emotion. And people are much more emotional and much more prone to bad judgment in crises than they are in bull markets, right? And so there's just a lot more of that to arbitrage. And so what are the lessons? Okay, so we've studied all these crises. We've studied them across the US, across Europe, EM, and there are really a few really simple recurring themes. Theme one, liquidity matters, okay? The lower the liquidity of the thing that you're buying, most likely the higher your forward returns, right? You, in the middle of a crisis and you have cash, right, and you're basically saying, rank everything from most liquid to least liquid, your cash is going to earn its highest premium buying the least liquid stuff, right? And the least liquid stuff also is the stuff that's sold off the most generally. So, it's a cross section of intersection, of both of those two things, but that's very true, right? And if you think of the high yield spread, or a financial condition metric like that is basically a measure of the illiquidity or premium, right? How much are you getting paid to take on risk right now? And high yield is, obviously a lot less liquid than investment grade. So, right, what's the spread you're getting paid to take it on? And the higher that level goes, the more you're getting paid. And so if you can buy micro caps instead of small caps, buy micro caps. You can buy small caps instead of mid caps, buy mid caps. You can buy mid caps instead of large caps, right? And I think where you don't really get paid as much, right, is buying the big market champions, right? Okay, like you have the idea of going to buy Procter and Gamble in the middle of a recession. Like, okay, right, I'm sorry, you're just not going to get paid that much for doing it. You're not actually taking a lot of risk, okay? But you go buy some crappy steel company, yeah, you're going to get paid if the markets recover, right? And you're probably going to buy that from someone who's liquidating their position and blowing out of it on some horrible day. And that's going to be pretty good for you. So that's lesson 1. Lesson 2 is value matters. Value doesn't always matter, right? In bull markets, often, markets price growth pretty efficiently. And so high multiple stocks tend to be high growth stocks. And so if bull markets are continuing, so oftentimes those high growth stocks can do pretty darn well, as we've seen. But in a crisis, that price you're paying for a given asset really matters. And what you tend to see is that the really cheap stocks are pricing, basically trend extrapolating bad things continuing to happen for every GDP-linked cyclical company. And what ends up happening again is that as the economy recovers, those companies actually grow the fastest. So at times of crisis, your cheapest stocks actually grow faster than your most expensive stocks, which is a totally crazy thing that never happens. And it's happening precisely because of this like crazy turmoil in people's expectations, where everyone's panicking, and actually that's kind of the most exciting time for betting that GDP is going to recover, right? And so if you buy really cheap things, you do extraordinarily well in the middle of a crisis. And the third thing that works really well, again, didn't work during COVID, is screening out bankruptcies. Things will go bankrupt in a recession, and you don't want to own things that go bankrupt. And so you should pay attention to credit statistics and just don't buy stuff that's about to go bankrupt. And those are the 3 things that work, right? And you can apply those in the US, you can apply them in Europe, you can apply them in emerging markets. And if you wait until a crisis and you go follow those 3 rules to the maximum extent you're able to, right? The smaller you can go, the cheaper you can go. And like, by the way, the smaller you can go, the cheaper you can go, right? You're getting into some unheard of crappy companies that look terrifying. And you're wondering why in heaven's name anyone would earn any money buying a printing company or, whatever, right? Or a newspaper business or some other piece of crap company. But those are the things that work. And they work best coming out of crises.
Now, I'm going to quibble a bit. I should quibble more probably in these podcasts, but it's a fine judgment. And the quibble is on this notion that value is objective and observable. It's trickier than that, right? It's like, as I point out to my wife, she's got a great deal in me. She's got a great deal, but some people can't see that. You'll be sure. I like to think my comic timing was on there.
Yeah, that was well done.
So the problem I've always had with value as a notion is, for lots of guys, value is really a statistically unusual deviation from the mean. But it's not a useful to note, because sometimes things that go down because they're going bust. And sometimes things that go down are actually money good and won't go bust. So I'm going to use the Russia context, although it's not my only crisis. You can tell by looking at this head that there's been a few crises in there. And actually, I could give you some Venezuela crises or some Argentina's another. Actually, Argentina's a good. I'm going to give you an Argentinian. I bought an Argentinian corporate bond that was invested in wind farms in Argentina. And the research I read said that they were money good. Although, can you really trust any research? So I thought, this bond is trading at 50 cents in the dollar, and it's meant to be a crisis in Argentina. But, I've lived through a lot of crises. And if they're money good and it's 50 cents in the dollar, I got to buy it because, if you don't learn from your experience, have you learned anything at all? So I did buy it. I also forgot loads of my experience because I bought a bunch of Argentina sovereign bonds as well. And what I found in the past is high quality corporate bonds, which are trading real cheap, they go back, they bounce. And if you buy a bond at 50 cents on the dollar and you don't have a very high tax rate and the thing's paying a 10% coupon, that means you're actually making a 20% yield on the thing over time. And you add all the cash flows up and just bank them, and it turns out to be meaningful money. Even more so if it's a 30 cents on the dollar bond. I mean, if you're good at equities, bless you. I'm not. I'm a bit too stupid to be good at equities. These things are subtle, right? I'm not good with subtle. So it's just all complicated for me. I just stick to these. Now, when I do the sovereign debt, that if it works great. You buy really cheap Argentinian or Russian sovereign debt, and if they are actually money good. The problem is it's not apparent what's money good until the crisis is finally over. So the corporate bonds will act real quickly, and they'll work as soon as the crisis is no longer extreme, because you figure out quite soon who can actually borrow money and who can't. Who's actually got assets, real assets, not goodwill assets, but real assets. And with the sovereign debt, that's a little different because they can haircut you multiple times and people know that. So that's where I quibble with you about this notion that value is obvious. It ain't.
Yeah. So we've been doing a lot of work and have another piece actually coming out soon about what's in a multiple. Why do some stocks worth more on a multiple basis and other stocks worth less, and how does that change or mean revert or persist, right? And essentially, a company's valuation is pricing in a mix of three things. It's pricing in growth forecasts, and it's pretty good at pricing in growth forecasts, right? So growth is unpredictable, but generally higher multiple stocks are going to grow a lot faster than lower multiple stocks, right? So growth, the market is as efficient as it can be. So, but it's pricing in growth. Then it's pricing in risk. Okay, so if you see a stock that's been really volatile over the last year, that's going to get a lot lower multiple than a stock that's been really stable. Okay, so and you can look at that or think about that as sort of a bankruptcy risk proxy or an event risk proxy. That and that's an important part of what a multiple is. And then third is sort of business quality. And so you can think about like gross profit margins or free cash flow conversion or things like that, where the market for good reason likes companies with higher margins and higher cash flow conversion. And I think where it's probably the arbitrage or the mean reversion is easiest. In a crisis, it's exacerbated, are the growth and the risk. And so in some sense, what you're doing in a crisis, whether you're doing that in fixed income or you're doing it in equities, you're going in and saying, hey, I'm getting paid a lot right now to take this risk, right? This stock is really cheap because of what's happened over the LTM period in terms of its vol, right? And so I am basically like shorting the VIX when the VIX is at 50 by buying this stock or this set of stocks or this type of bond. And what you find is that those risk levels aren't that persistent. So 5 years from now, are the stocks or the countries that were really risky at that moment the same ones? Not really. Like our notion of what's really risky changes. And then growth is the other one, right? So, and again, we've talked about this. In a crisis, people's growth expectations are wacky, right? It's really hard at March 2009 to make a good set of growth predictions. The market's making a lot of mistakes. And the biggest mistake they're making is they're really overvaluing safety in the crisis, right? They're overvaluing your Walmart, your Procter & Gamble, et cetera. And they're undervaluing the cyclical rebounders that tanked coming in and will rally coming out. And so I think that it's in the growth forecast that you really see that valuation mismatch in times of crisis, as well as in the risk metrics. The quality metrics are more stable.
Is it really a question of a conscious undervaluation? Is it an error? I think like what I saw with, say, an investment bank selling out Russian counterparties' collateral was not an error, right? This was not someone misjudging the value of Russian collateral. And God knows they could have done this. It was a difficult environment, so anyone could make mistakes. But this was actually a liquidity situation where you were a forced seller. It did not matter whether you loved the business environment. It did not matter whether your projections were X or Y. You were being kicked out of that trade, and the terms of that exchange were being dictated to you. And I wanted to just touch on something because right now in our work at MI2, one of the big debates we've got is, is it safe? Hopefully, I don't know. Have you ever seen that movie Marathon Man with Laurence Olivier and Dustin Hoffman? And Laurence Olivier is a Nazi who's hiding in South America, who has a bunch of diamonds somewhere, and he decides he wants to come to New York to get his diamonds, but he doesn't know whether the environment's safe, so he tortures the Dustin Hoffman character by pulling his teeth out. It's kind of my investment banking career. It just reminded me of it.
Yeah.
So. But the big question here is it safe? I think a lot of people will tell you we're in the middle of a crisis. I would argue we're in the foothills of the eventual crisis, and it's going to get worse, and it will get worse until the Fed has decided that they've arrived where they need to go. And it doesn't look to me as if the Fed's reached that determination yet.
Yeah. So, and Harry, I hate to be a consensus thinker. I hate it. Every bone in my body wants to be a contrarian, but I'm sorry. I agree with the consensus here that we've got dark times ahead. And I'd say the reason I think that, right, is if we looked at every past Fed hiking cycle and what we found, and we looked at high yield spreads, okay, which is our preferred financial conditions metrics. What we found is that financial conditions reach their bottom after the Fed has stopped hiking. Fed keeps hiking. The Fed only stops hiking when they see pain in the market. And by the time they see pain in the market, that pain is spreading, right? And they can't do anything, right? So, and then, the market yields on treasuries and stuff start coming down as people panic. And then the Fed starts easing, right? But I think what's crazy to me is, right, after looking at that analysis, which I should have done a lot earlier, I only did it a month or two ago, is that there are all these people saying, "Oh, I want to front run the Fed pivot." I'm like, you don't want to front run the pivot. You want to be lag. It's fine to lag, right? Things are going to get worse after the Fed pivots, right? Because they're only going to pivot because they're really panicked, and they're probably panicked for relatively good reasons, and they're not panicked yet. Right? Are we seeing problems? Yeah. Look at the housing market, right? Not doing too well. Are we seeing problems elsewhere, right? Yeah, right. Go check in on your friend who bought a bunch of high growth, small cap software names and cryptocurrencies, right? Yeah. It's not doing too hot, right? But are we at real pain, right? Not yet. We're not there. And so I think your analogy that we're in the foothills is right. It's hard to see, the Fed has an explicit goal of tightening financial conditions in order to bring down inflation. And they say they're going to keep doing it until inflation comes down. Inflation statistics look bad and they're getting worse, right? So the Fed and the labor market's fine. So the Fed has no incentive to slow down or stop or do anything until they've actually inflicted real pain, which they haven't done yet. And they watch the high yield spread too, okay? And the high yield spread has come down since June, right? It's elevated, right? Market participants know something bad's going on, but it's not crazy. It's not in crisis levels. And until it is, we're not at the bottom.
So, just for a change, actually, let me rephrase that because it's not going to sound nice. My colleague Frank, who produces this, who's way better looking than me, so God knows how you managed to confuse me for him. But at the beginning, Frank did a whole bunch of prep for this, and he had a couple of questions as well. And I thought, people should know Frank exists.
Yeah, that's very generous of you, Harry.
I'm never generous, but
I think it's good that Frank exists.
Frank, you exist, don't you?
I do. I exist.
So you had some questions about the UK. I think you had a question about whether the UK is in crisis, whether it's an emerging market. How dare you? Go on.
I knew you would take offense to that. I find it to be interesting, Dan, that a former U.S. Treasury Secretary, being Larry Summers, warned last month that the UK was behaving like an emerging market. This was his quote. He said, "It makes me very sorry to say, but the UK is behaving like an emerging market, turning itself into a submerging market." Now, you think about the pension collapse right now. Well, not a collapse, but it's in crisis. Inflation there is way worse. The energy crisis is not in good shape at all in a lot of places around there. And I just find it to be interesting that, a very prominent, U.S. federal official had to say that. I mean, what do you think of when you hear that quote coming from somebody who held such a prestigious position? I mean, what's the first thought that goes through your head? Is it absurd to you, or do you think that there is maybe a little bit of credence to his comment?
Yeah, well, first, I'm an Anglophile. I mean, I love the history of England. My great uncle gave me a piece of Margaret Thatcher's china for my wedding gift. So, I have a deep love for England and the many wonderful things England has done in the world. But they're in a tough spot right now. I think it's really sad, first and foremost, right? I mean, I think the economic problems they're facing and the years of bad leadership that led them here, it's really tough. And it's hard to see how they get out of it really quickly. And I think all the things that we say are bad in the U.S. are just worse in the UK. I think on the other hand, right, look at GDP per capita. This is a very robust, well-functioning financial system. It is not an emerging market. It is not about to be destroyed by one set of bad leaders or one policy change. So I think it's an exaggeration to compare it to an emerging market, right? It's not Poland. It's not Malaysia. It's not Hong Kong.
I know a lot of people who speak really well about Poland, by the way.
Well, yeah, so I don't want to
you've got a whole bunch of Polish guys coming looking for you in your offices.
Right, but you just think about, are you a country to which people immigrate or a country from which people emigrate? And the UK is still a country to which people immigrate. And that's not the definition of emerging market, right? It just isn't. And so I think that the UK hopefully will recover. But I think the EM quip is an exaggeration. And again, I think things are going to get worse before they get better, right? I still don't think we're in a full-blown crisis. The UK stock market's not down 50%. But if it is, I think it'll be a pretty good buying opportunity.
So I have thoughts on the UK. I can't help it. I have more thoughts on Tottenham, obviously. But the first observation I've got is, what an emerging market usually is? A country with a high debt to GDP ratio, right? So there's a lot of countries right now with much higher debt to GDPs than they used to have. And we shouldn't be so surprised if you walk like an emerging market and act like an emerging market in policy, some people are going to note the similarities. Now, I'd also note that Larry Summers, people in the Boston area who attended some colleges in the Boston area may be familiar with Mr. Summers' ability to put his foot perhaps where a foot shouldn't go if it wants to remain pristine. Right, so it wouldn't surprise me. It's possible for Mr. Summers to err in his public pronouncements in a way that perhaps he'll subsequently regret. But I do think that the UK is instructive because, part of the question is, are we in a crisis? This podcast is kind of like crisis investing. And one of the ways is when people compare your country to an emerging market, you probably are in a crisis at that point. If people are saying Brazil, debt to GDP of 75%, UK, debt to GDP of 100, maybe you got a problem. So I think that's one observation. And the other observation is there's ugly competitions all over the world right now. Why are you buying European Union government debt? It's not like it's got a great debt to GDP. It's not like the energy sector is looking robust. There's all sorts of potential problems and, potential in the sense of I'm potentially going to die at some point in the next 50 years. There are clearly going to be bad things that will happen. The only question is whether that's reflected in the price. And I would argue you'd be surprised how cheap assets can get. Right, that's the bottom line. They're cheap now. I'm sure you'll be okay if you bought them. If you bought Linkers where you buy Linkers now, I'm sure you'll be grateful in 10 years' time. But I suspect you'll get a better deal at some point in the next 6 months. Dan, Verdad, Spanish for true. Is that why you named the company Verdad?
It is, Harry. There's a school in Cambridge I went to that has a Latin version of that motto. And it turns out that when I was trying to name the fund, it's really hard to name a hedge fund because everything is taken. So I can't say this was like my top choice for a name. It was like 25th on my list, but we got there and it wasn't taken, so we went for it.
That's right. I mean, because everyone's got Zeus capital, Athena capital, Aphrodite capital.
Even the obscure Greek deities are taken. And then every combination of a rock and a piece of water are taken. Blacks, or colors and stone, black water, black stone, white rock, whale rock. I mean, you just go through. It's just really impossible.
For some reason, Tupac capital has not been taken. It's weird. For some gangster,
every beach in Nantucket has a credit head fund named after it. I mean, you just gotta go through.
It has the advantage that you know where they're located. If it's a beach, if it's a town in Westchester County, you've got a good idea where they're located. In fact, I'm surprised they're not all called Midtown Capital. People have a fundamental lack of imagination, which is kind of illustrated. If people wanted to keep abreast, your website has God knows how much material that, if you're interested in what happens when markets are blowing up, your website would be a great place to look. What resources where can you refer people who want to keep track of what you're thinking?
Yeah. So our website, verdadcap.com, is a great place. I'm on Twitter at verdadcap. And then we write a weekly research piece. So every Monday morning, we publish a piece that's sort of our latest thinking. And so you can sign up for that on our website or through my Twitter profile. But that's definitely the best way to keep abreast of what we're thinking.
It's been a pleasure. We should do it again at some point.
I know. This was great. Maybe when we're actually in a crisis.
It can't be that far away, can it?
I know. So we'll schedule it for 3 months from now.
Dan, it's a great pleasure. You have a good one. All right, that's a wrap on The Next Big Trade. Be sure to subscribe wherever you get your podcasts. And as always, head over to realvision.com for financial insight you won't find anywhere else.
Hey everyone, thanks for watching. If you like this show, you're going to love Real Vision Essential. At Real Vision, we talk to the most successful investors in the world and deliver videos that make finance interesting. It's all about helping you become a better, more confident investor. Now, we could dress that up in fancy marketing buzzwords, but it's really that simple. Oh, and right now, you can join Essential for $99 for a full year instead of the usual $239. Visit realvision.com/essential99 to join the Real Vision community. That's realvision.com/essential99.